Joining me is Feroze Azeez, who's the joint CEO of Anand Rathi Wealth, to discuss more about markets and, of course, what lies ahead. Feroze, good afternoon. So good to have you back. Sharp fall again, Nifty at 2 months low. And, we were hoping for a peace deal, but fresh tensions continue to dim that hope. But oil still below that $100. But now we have a problem with rising yields too. So at this time, how should investors navigate the uncertainty?
I think, the uncertainty has been reasonably large. But if you look at after the war, the Nifty went to 22,313 and crude went to 124 intraday and about 120 on a closing basis, if I'm remembering it right. So with all the lot of news pessimism, I think the markets are still about 4-5% higher, 3-4% higher on Nifty. Now, if you look at the model portfolio, which I recommend as a company, after the war has broken out till 3rd June, it is down just 2.5%. So what I'm trying to say is the long-term investor is today far more pessimistic than mathematically he or she should be. Now, I calculated the returns of several of my clients' portfolio from 26th February till 3rd June, which I did this study. Most of our clients are down 1%, 1.5%. But their mood is like they've lost 25% of their wealth. So point one I'm trying to say is, if you are a long-term investor, be very mathematical about your pessimism or optimism. That's point one. Point two, a long-term investor needs to ask one primary question. If FII is selling, DII is buying, how long can they buy it for? That's the most important question. If DIIs have to continue buying, that's the premise on which the market is at 23,100 anyway on Nifty. What is the cash surplus? So at Anand Rathi, we calculate actual approximate cash holding of all the 900 odd funds which invest in equity in India. Now, the cash balance as of 3rd June again is 1,61,226 is my estimate of what cash balance exists. On the beginning of the June month, the cash balance was almost about 1,70,000 crores. So what I'm trying to get to is, there is a cash in mutual funds which has depleted from 4th of May, which was 1,95,000 crores, down to 1,61,000 crores. So cash 30,000 crores has been depleted, but there's a total deployment of mutual funds of almost 73,000 crores because they got 36,000 crores in the process for the last 1 month. So mutual funds are getting money, so they're absorbing all FII outflows, and the cash doesn't seem to have depleted significantly, that it is on a very worrisome level. So I would say markets are buoyant, especially on the broader market side, where FII selling is far lesser than the top holdings of Nifty and Sensex.
Okay, got it. But Feroze, from the last 2 years, investors have been questioning, that there have been no returns. Markets remain quite fragile. And now that we have the fresh risks of energy supply shock, the growth might remain in low single digits. I mean, at a time like this, how would you convince investors to look at equity markets?
I think Lovisha, investors only question things which have not done well, and they fall over each other to buy things which have done well. Let me give you an example. Bitcoin is at a 5-year low now. Yesterday it was at 59,000. Nobody's talking about Bitcoin today as an investment opportunity at the peak. So it is at half the price, but people don't want to buy it. At 1,10,000, my clients were fighting with me in an event, saying that yaar tum Bitcoin kyun recommend nahi karte? Right? When gold was at $5,600, nobody wanted to stop buying. In January, they bought 24,000 crores. Last month was the first month in the last year, if I'm not wrong, where gold ETF saw an outflow because gold is not at the peak. NASDAQ, kahin bhi dekh lo, what will happen is investors will only question things which have a potential to grow, and they will fall over they will be head over heels in love with an asset which has done well in the recent past. So that's recency bias. And to address that is why they need a wealth management firm or a professional like me for whatever it's worth. So coming back, how do I convince them? I don't convince them. I just show them data that in the last 25 years, there have been 6 financial years where Nifty has been negative. There have been no successive 2 financial years where Nifty has been negative. And last financial year, which is FY26, has been a negative year. In that case, what are the odds that FY27 will be negative? If it is not negative, What does it has to beat? It has to beat an FD return, which is post-tax 5%. What are the odds that on this year, where my mutual fund portfolio 14 scheme basket is at 11% positive, will not even end up at 5% positive. So since Nifty, whenever your hopes are least, is when the probability is highest. If one could understand this part of investing, then they will understand and respect mean reversion. So long-term investors should stay put, one. Second, they should add like lock, stock, barrel. Third, they should be prepared for 5-10% correction at all points in time. If you don't have that stomach to weather a 5-10% volatility, you better are suited for an FD. All right. So these are the three things. And then will you make 14-15% compounded from here on till March 29, which is 3 financial years completion? Mark my words on this, the odds are 95% plus.
Okay, got it. Feroze, I mean, we have seen that the government has removed the withholding and capital gains tax for FPIs and government securities. How transformational do you think the move is compared to earlier bond market reforms?
I think it is not transformational. It is hygiene. See, withholding 20% of tax from a person who has come through a safe haven is a logistical nightmare for the person who is giving you and he's taking it back. And FPI is not going to let back a claim, right? They have somebody to be answerable to. So the 20% withholding tax was wasteful compliance, not even helping the country, because that was anyways being claimed back. If you're coming through a Singapore, let's say, then you don't have taxes. So you were going to claim it back anyway because of the DTA, dual taxation agreement, avoidance agreement, DTA, right? So that's something which was to be done. Capital gains in bonds are rarely there because after 1 year, if you own something, it's unlikely that there's an interest payment already. So that is not so. So I personally think that we have done the right thing. Is it transformational? The answer is no. What was transformational was on 5th of June or 2024 when we got included in the JP Morgan bond index. I forget the name. And that is where we went into 1% per month. Till March 25, our weightage is built to almost 10% in the bond index. That was one of the first few times we have had inflows. Now coming to what have we lost after the war? Whatever we lost, I think now we have about 3,30,000 crores for FPI money in GSECs. That had gone down by 10-15,000 from February to March end. That's come back up. So now what am I looking forward to is getting included in the world government bond index, which we are not a part of. And there's a Bloomberg aggregator index. If I remember the name right, I'm expecting a 0.7% weightage there. If that were to happen, then there will be influx of money. But the fact that we are ready to give a tax relief to FPI gives me hope that we will think more rationally on the equity side, because I think we having increased the equity taxation from 10 to 12.5 was not here nor there, and it was a self-destructive policy itself, because there were no capital gains left after that. So what are we going to tax at 12.5, which we couldn't tax at 10? And then you have the surcharge and cess, which brings it to a non-clean price of 14.94% taxation. STTs to buy and sell Nifty right, in the cash market are almost like 60 rupees you lose. And that's creating a huge arbitrage between futures and cash market. And there is so much anomaly. There's so much anomaly that there is one stock in Nifty trading at a forward of 12%. And there is another Nifty stock which is trading at a forward of 2%, in spite of having lakhs of crores in arbitrage funds, because the transaction costs are so ridiculously high that markets have become inefficient. In a Nifty kind of an index, having two stocks quoting at a different premium in the futures market is an evidence that market efficiency has got compromised.
Okay, got it. Feroze, I mean, there is talk of 25 to $30 billion in passive inflows, by the RBI measures. What kind of timeline should investors expect that realistically these flows can come in?
See, passive inflows are going to come because of weights and inclusions, not because of tax differentials. Because passive guys don't apply judgment. Neither equity passive money comes on the basis of tax discounts, they have to be on the basis of inclusions. Those would have come irrespective, is my judgment. Active bonds participation will definitely increase, but passive would not increase substantively because they are not tax dependent. They are weightage dependent. On the equity side also, if you look at how passives have operated, if you see the India MSCI, every MSCI operates two indices in each country. One is called the Standard Index, India Standard Index, which has about 160, 170 stocks, which covers 85% of the country's free float. And the other 14% of the country's free float, up to 99, is captured in the small cap index, which is India Small Cap Index, has little over 500 stocks, if I'm not wrong. So in that, the passive guys have continued to buy because the standard index stocks are shared as a weight in the emerging market index with all the Taiwan and the Korean and the Samsungs of the world, which have eaten away a lot of weight from us. That's why the HDFCs and the Reliance and the top 10 stocks of Nifty have not delivered, because they share an index in the emerging market index with other heavyweights which have done astronomically well. So that is why the broader market looks prettier than Nifty. In fact, Nifty looks so much more prettier than Sensex, just because Nifty has 20 more stocks. Nifty has outperformed Sensex by almost 3% in the last 4 months, which has never happened in the Indian history of Sensex and Nifty. Now, nobody seems to be talking about it. That's how the top 10 stocks have got rogered, because BSC has, on the same top 10 stocks, has 64% weight and Nifty has 54% weight. So wherever a stock is sharing an index with a TSMC, for example, or a Korean market stocks, weight is being lost, and that's where passive money is going from the bigger stocks than the smaller stocks.
Okay, got it. But then, Feroze, we also have, the Japanese bond yields, which is rising, and then the US bond yields are also rising. So at a time like this, even despite the government's efforts, do you think our debt market would be more attractive compared to them?
I think, yes, you're absolutely right, Lovisha. The relative attractiveness of Indian bonds is reasonably low. If you see the spreads between the US Treasury paper and the Indian RBI or the government paper have been one of the least. Okay, about 3 years back, the 10-year GSEC of US was about 1.75, I'm not wrong, and India's 10-year GSEC paper was almost about 7 quarter. So the differential was 5. Now the differential is 2.5. Of course, the relative attractiveness of the US Treasury bonds or the Fed paper is far more than the Indian yields. And now the silver lining in the dark cloud is the fact that we are not operating at yield levels which the country is not used to. But US and Japan are operating at yield levels the country is not used to, right? Nobody in the world would have almost imagined that the spread will become so small. For the RBI, 7% 10-year GSEC is business as usual. For them, 5% plus 30-year paper is something which they wouldn't have visualized in their even nightmare. So how will they function is something, if there is any AI bubble burst, how will that function? We don't know. But I'm happy that we are operating in a more normal yield environment. The average yield, 10-year GSEC yield for the last 10 years is 6.82%. So I'm very close to my averages. So that's business as usual. RBI is not grappling with unprecedented, uncharted territory, but the US Fed is.
Okay, got it. It's been 100 days into the war. We have oil averaging at about $95. At what price do you think the market can start materially downgrading the FY27 growth expectations? And of course, for you also, what lies ahead in terms of FY27?
Lovisha, we did a study. See, I think I had called out saying that the peak of oil is behind us. When it was at 115, 170, people were speaking about 150, 200. So oil is not such a rare commodity. Disruptions can happen, but supplies will come. That's the reality. Yeah, we analyzed 12, 13 such instances from 1971, where there were several instances where oil went up more than 50% in one rally. More often than not, or not more often than not, most of the times except two, where the rise was basically demand driven rather than supply driven. Price didn't come down. One was in the GFC, the price went up significantly of oil from the 2008 lows when the demand was low, and after COVID, it went up again. But these are the only two instances where 1 year later, the price didn't come back down 25%. The other 11 instances or 10 instances, crude came back 28% than the peak it established. So my call on this financial year's median and the mean of crude prices will be between 85 and 88.
Okay, got it, got it. But going ahead, Feroze, I mean, if you had to choose one theme for the next 3 years, which one would it be, and of course, why?
See, if you're speaking about next 3 years, I would say that banking is one place where I would definitely be. Asset management companies are very, so financial services, these two places. And then you look at anything to do with capital goods in terms of the kind of capital expenditure we have on our total budget is very high. Anything which is manufacturing led, agri led, if I have to be inward looking rather than outward looking, given where the circumstances. So banking and AMCs, asset management companies for sure. Basically, the Nifty Capital Market Index, which Motilal Oswal formed to replicate a product which had about 15, 16 stocks, is something which I would definitely keenly look at, because today in Nifty, you don't have one capital market stock in it, surprisingly. And if India has to be financializing significantly more, not having Nifty, not having any representation of the Nifty Capital Market Index stocks in Nifty seems unlikely. So you have to take a bet of which of those stocks or which of is the index. I think the index is capable of beating Nifty by about 4-5% per annum for the next 3-4 years.
Okay, got it, Feroze. Feroze, and on the flip side, if you had to, avoid a theme for the next 3 years, which one would it be?
So I would definitely try and avoid on the IT side, because that's so much of uncertainty in terms of how things will pan out. Of course, I don't believe the kind of hype AI gets. I generally count US hypes from the last 25 years, and then I realize most often than not, they tell you that you're dead if you don't adapt to this, be the Y2K, be it the Web3, be it the blockchain. We won't be able to live without it, is what the kind of meta we will always be meeting in virtual worlds, and none of us will ever go to Times Square. We will wear 3D glasses and meet in Times Square. So people have sold hoardings there. So, and they've now finally shut it down. So I'm not, of course, AI is a very important development, but I would say I would avoid IT because it's too dynamic a landscape. And that's the only thing I would avoid.
Okay, got it, Feroze. All right, Feroze, on that note, we have to let you go, but thank you so much for joining us.